Realogy Holdings rallying more than 2% right now after beating Wall Street estimates for earnings. The real estate brokerage, which franchises brands like Century 21, Coldwell Banker, Zip Realty, and Sotheby's, reported revenue of $1.5 billion with earnings per share of 68 cents. Joining us now, first on CNBC, Richard Smith, Chairman, President, and CEO of Realogy Holdings. So, Richard, take us beneath the headline numbers and give us a little color on what you saw during the quarter in terms of housing sales and deals and transactions.
Good morning, Sarah. Thanks for having me. We're seeing more confidence in housing than we've seen in the recent several years. So I think people are generally of the view that housing now is a good buy, and they're jumping back into the market now slowly, but nevertheless, I think the solid quarter. We're compared against a very weak quarter in 2013, if you recall. That was a quarter when everyone accelerated closings ahead of a rising rate environment. We do not have that dynamic today, but what we do have is, I think, increased confidence in the housing market.
You know, we just learned this week, and thanks to Diana Olick for pointing this out, our housing guru, who I know you know, Richard, that the percentage of home buyers that were first-time home buyers dropped 33% this year, the lowest in nearly 3 decades. What's it going to take to bring these first-time buyers back to the market?
Well, actually, it's just marginally down. The first-time buyer has been slow to get back into the market. I think it's a combination of issues. One, the traditional form of financing a first-time buyer purchase is FHA. FHA fees are very high, extraordinarily high, actually. I think those fees are going to have to come down. The underwriting standards do not have to change, but the methodology is going to be a necessary change. And that, what I mean, is that banks have a very difficult time adjusting to the new environment, which holds them accountable even for technical defaults. So the putback risk is very high, and lenders know it, and they've been reluctant to lend to first-time buyers for that reason. The first-time buyer traditionally is a higher risk buyer, but with some, I think, basic considerate underwriting, we can get the first-time buyer back in the market.
Sort of curious about your response to the Zillow-Trulia merger. Is that going to have an effect on your business?
Zillow and Trulia, amongst many others, are very good suppliers to us. They're good alternatives to traditional print media. I think on a combined basis, to the extent they continue to represent the same value that we see today, we're fine with that, and we've clearly indicated that to the market.
What about the information that seems to be migrating online at this point? Is that causing any decline in the fee that brokers charge?
No, actually, if you think about it, put it in that context, you're taking offline information and concentrating it into an online application, so it's more convenient. It makes for a better and a more informed consumer. So we have not seen that, nor do we expect that to happen. We think a better and more informed consumer is good for our industry and good for housing.
Mr. Smith, can I take you back to where we are in housing more broadly and the issue of first-time buyers, as Sarah brings up? Is the market failing? I don't know what proportion of what you sell are new builds, but there is a suggestion that the market is failing to supply what's really needed. In other words, the home buyers, in order to maximize their profits, are basically building bigger, more expensive homes, and they're not giving the supply that the first-time home buyer might require, or less profitable ventures. Is that something that you see? Is that something that we need to be cognizant of and try and deal with in some way?
So, Simon, that's a very astute point. Builders are reluctant to build first-time buyer product. Their margins on that business are typically lower than the higher-priced homes, but they will reluctantly get back into that market. Several have indicated their intent. We think that will happen sometime in 2015. We also believe that many of the homes that were acquired by institutional investors will start flowing back into the market as homes for sale. So to meet that demand, there must be product, and the products have to slowly come back into the market. But we're confident it will.
Richard, very quickly, Republican Congress, does it change anything when it comes to Fannie and Freddie reform?
No, I don't think so. I think there will be a lot of, cat-dog fights over the next 2 years. But I think what's important is that we'll have a pro-economic growth agenda, and that's going to be good for housing.
All right, Richard Smith, thanks for joining us on your results and some of the broader themes in the market today. The CEO of Realogy Holdings.
Okay.